Good evening, everyone. Welcome to this evening's presentation. My name is Adam Harris. First thing, can I do a sound check? Can you just confirm for me that you can hear me? Good to see you back, Stephen. I recognize some of the names. Good to have the regulars back, as always. And just checking that you can hear me correctly. Okay, good. Fantastic. Nice to meet you as well, Vincenzo. Very good. And right, my name is Adam from Trade with Precision, and welcome to this evening's ATFX webinar. We're going to be talking about trading with Fibonacci levels. And I'm obviously just sort of kicking off slowly to give any late joiners a chance to get into the webinar. So, because that's often the case that I have to keep in mind. And I'm going to give you an opportunity to read this disclaimer. I think there's two. I'm going to give you a moment to read the disclaimer, and I'll tell you a little bit about myself. For those of you who don't know me, I'm based in London. I'm a fund trader. I'm one of the traders and analysts with Trade with Precision, as well as trading my own funds and client funds as well through regulated entities in the UK and outside the UK. And I am pretty much all yours for the next hour, so please feel free to make this as interactive as possible. I would love to assist you if I'm able to. And what else? I'm a trend trader. This is a very important component. This means that I'm very selective about the markets I get involved with, and I hope that over the next 60 minutes, I'm going to be able to convey why that is to you. And what else? I'm also a swing trader, which means that for the most part, I am getting into my trades on the daily or potentially the 4-hourly time frames. I hope also to make that pretty clear over the next 60 minutes. And the earnings, whether that makes me a swing trader, that is the traditional definition of a swing trader, is entering on the higher time frames, the daily or the 4-hourly. And a day trader is usually a trader who trades completely within certain hours, 9 to 5 or 8 till 6, for example, and they are usually closing out their trades overnight. And they are usually trading the lower time frames, which could be 1 minute, 5 minutes, 15 minutes, 1 hour. All right, so that's generally speaking the difference between the two. Let's have a look at your comments. Good, fantastic. Okay, so on the agenda, we're going to be covering how to correctly draw a Fibonacci retracement on a price chart, Fibonacci mistakes that can lead to misleading signals, how to set up the NT4 Fib tool as per your personal requirements, how to turn Fibonacci signals into potential trading opportunities, and also real-time demonstration by myself while we have a look at the markets and reading key Fib levels on some of the current hot markets. And then we'll come back to this at the end, which is the why choose ATFX. So let's just go and have a look at this. What I'm going to do is leave it on the agenda. Okay, I can see the numbers are climbing. So welcome to those of you who are joining us. I know that sometimes you don't necessarily get into the webinar immediately. So again, just making sure you can all hear me. There are no issues. That's all good. So what I want to do before we get to a couple of these items here, for example, correctly drawing Fibonacci, and how to turn them into potential trading opportunities, is kind of outline the approach for trading. So I think I started looking into trading initially. My previous life, I was doing technical visual effects in the film and television industry. So almost a very different type of life. This and around about 2007, 2008, it occurred to me that I wanted to learn. I wasn't a financial person, but it occurred to me that I was very intrigued and interested in learning how to trade stocks. Around about 2009, I had the time, sold my shares, had the time, moved from South Africa. I was ping-ponging between Switzerland, Zurich, and South Africa, and decided to settle in the UK, and decided to then commit myself. And at the time when I Googled how to trade stocks, what actually came up was trade Forex. So at the time, didn't really understand what that meant, other than the fact that Forex was new and that was really what everyone was trading, in the same way that today everyone's trading cryptos, and a couple of years ago was binaries. There's always something that's going to be relatively new. To this day, I'm just obviously quite old-fashioned in my own way. I have always kept an eye on trading stocks, but the point I'm trying to make here with this is that the markets are ultimately really the markets. There are some subtle differences between currencies, commodities, and indices. And really what's most important, and this was something that I learned from Nick McDonald. So I spent a lot of money, a huge amount of money on education back then, and some value in it, some not so much value in other parts of it. But I did eventually identify, especially through Nick McDonald at the time, before I really joined TWP, that trading was a lot more about the conditions, the market conditions. There's a couple of key things I want to get across to you. They are relevant to the agenda, so I'm not digressing. They are relevant. But what I also want to do is get across to you the importance, the kind of the idea of what it's like to actually be a trader. So there's going to be a couple of things. The first things I thought that you might be interested in is at TWP. All right, so I'm just going to type this up because, ooh, okay, so we're all capitals, are we? At TWP, all right, we think it's reasonable. All right, I won't type it, I'll just tell you this. We think it's realistic to look for 2 to 5 trades per week and ideally getting a net profit of 1%. So in other words, what we're doing here is keeping our expectations realistic, but at the same time also making it achievable. All right, it is achievable. We should be able to do that. And then ideally that would compound to approximately 5% per month. All right, so that's kind of what we're looking for, whether we trade the daily or higher timeframes or the lower timeframes. The income potential is the same. All right, so you don't make more money if you trade the 5 minutes unless you have a particular strategy that only works on that particular time frame. But if we're trading trends, for example, and there's a good trend on the 15 minutes or there's a good trend on the daily, my potential profit or potential yield per month is approximately the same. Okay, so day traders and swing traders, earning potentials are pretty much the same. So the difference between the two is usually as a result of a lifestyle choice. And so what we do look for, and this is where I'm going to start to outline these, is that market conditions matter. I was thinking a lot about this. I went for a walk just before the webinar started, and I was thinking a lot about this. Market conditions matter almost more than anything else. So this is really where people get waylaid in the beginning. All right, so Google searches do not provide a huge amount of very helpful, or at least even if they provide helpful results, it's very difficult to separate the junk results from the helpful results when it comes to trading. And actually, there are other industries that are like this. It isn't just this one. If you start to look into, for example, eating healthy, you're going to get somebody who says butter is bad for you, somebody says butter is good for you, somebody says you've got to go vegetarian, someone else is saying you have to have protein. There's a lot of conflicting information, and it's incredibly difficult to usually to track down someone who really does understand how things kind of work in that industry. And trading has just been so popular the last few years. There's a lot of I guess, useless information mixed in with it, and useless in terms of just not really adding value. So market conditions matter, and this is what I really want you to take away from this. It very much matters what kind of conditions we look to participate in. Okay, that actually matters much, much more than what it is we're trading. All right, it matters much more that the market has a very clear direction than that it's a currency, that I'm trading euro dollar, or that Brexit is on the news and I'm trading the pound. That stuff doesn't matter at all when compared to market conditions. And this is something that I just don't see enough professionals emphasizing. What they do is they talk about what's going on with the euro or what's going on with the pound, as opposed to whether it's actually tradable or not. They talk about key levels. And I think, excuse me, there's a big difference between market analysis, which is identifying what the conditions are, or whether we should trade them. Okay, and that's hugely important. And I don't think that is identified clearly for people who are wanting to learn how to do this so that they can earn a secondary or primary source of income. So that's quite important. The other thing that I want to highlight here is that we're talking about technical analysis this evening. That's what we do at Trade with Precision. I've been everywhere. I've thankfully rubbed shoulders with professional traders. We've all done it. We've all tried to tie in what we think the market should do with what we've heard in the news. We've formed an opinion. We've read the Financial Times. We've followed a blog somewhere, and we've formed an opinion as to what we think the market should do and why we should be trading it. And that basically always ultimately results in losses. So fundamental analysis works incredibly well when we're looking at individual stocks, where we can determine what the actual value of the market is. When we have that information, it's a finite amount of data, and we are able to achieve an opinion or to arrive at an opinion as to whether we think the market or that particular instrument is overvalued or undervalued. But to look at a currency, for example, on your own, and have a limited access to information, and try to arrive at an opinion as to whether an entire economy is undervalued against other currencies or against a particular currency is nigh on impossible. So we don't do that. We're purely technical traders. We look at the conditions, and then we make a decision based on that, whether there are any potential trading opportunities. Okay, so that's the next thing. So when I talk about market conditions matter, a market can only exist in one of two states, right? It is either trending or it is not trending. That's it. If it's trending, it's either trending up or trending down. Okay, but it's moving at least as a given direction. If it's not trending, there is no money to be made in those market conditions. So what do I mean when I say that? Let's pop across to the platform. Let's have a look at what we define, or what I define as trending or not trending. So I'm going to just go through this. I want to do it sort of live in front of you and go and look at a few of these things. So looking on the platform, the time frame for now is not as important as it should be. But if you look at this, and I've also got various different color layouts, so don't worry, I'm not always going to be using green on black. There are times when I've got, this is the sort of traditional layout that we use. This is gold. I can tell at a glance. Is it gold or silver? It is gold. This has been on my watch list for a while. I've highlighted areas where I'm looking for entries. I will come back to you, and we'll talk about that as well. So the point is that we start to talk, you hear traders occasionally talking about price action. At the end of the day, price action is the candlesticks. These are the bars or the candlesticks that we see, so we can look at it in different formats. We can change the colors. It's not too important. If we don't overthink it and don't over obsess about it, there's a lot that we can work out. So this chart, regardless of the time frame, is a great example of where there's no real clear direction. Okay, if we look at the last 10 to 20 bars, there is no clear direction compared to, for example, compared to this period here. There was a very nice trend in place. Actually, during this period here, there was also a very nice trend in place, but currently there are no trending opportunities. So what that tells me is, as a trader, there are no money-making opportunities on this instrument, which happens to be oil, US oil. There are no money-making opportunities on this chart right now. That's it. End of discussion, meaning I walk away from it. So there's no more analysis required. There are no money-making opportunities here. If I go to the daily, there isn't anything really going on here. Whereas there were great opportunities over here, great opportunities on the way down. At the moment, there aren't any. Okay, it's really stuck within a range. It's incredibly volatile. There's a massive battle going on between the bulls and the bears. And because of that, because there's this battle, the market is capable of changing its direction at any point. Now, usually, we identify these locations where the market can change its mind by identifying key levels. So the first thing that is the most important item on our chart is price action. The second thing is horizontal levels, for so many reasons. Okay, first of all, they help us identify and frame price action. They organize it. We can organize price action by going, okay, these are key price levels. So once I've identified them, I can actually identify where price is capable of changing direction. Okay, so changing direction, by the way, I'm happy to use either candlesticks or price action. I could use a curve as well. I find and prefer that, like here, for example, it's quite nice. There's really, obviously this particular level is significant over here. But if I go back to the bars, I can see this. So this is all going to come into play when we have a look at Fibonacci. So the first thing and the most important thing here is that I'm not looking to trade this at all. If I go down to the lower time frames, the problem is that statistically, we need to be trading, even if we're trading the 15-minute time frame or the 1-hour time frame, statistically, we need to be trading in line with the daily direction. Otherwise, we're likely to have more losing trades than winning trades. If the daily is trending upwards and we are buying on the 1-hour time frame, statistically, we will have more winning trades. It's just that simple. It's mathematical, but it's probabilities as well. The issue I have is that because the weekly isn't really going anywhere and the daily isn't going anywhere, I think, I'm just going to check, my mouse batteries just died. Give me 10 seconds to change it out because I have spare batteries lying around. So because the daily and weekly isn't really going anywhere, there's no real opportunities at a glance on the lower time frame. So this is what I'm actually telling you here is really a scanning technique as well. If there's nothing happening on the lower time frames, there's just nothing. I can let this go and come back to it at some point in the future. But it's not really worth my while now. So I'm going to get rid of this. Oil is just not worth my while, and have a look at a few of the other markets. Okay, so I've just created several windows where I'm looking for these opportunities. And the next thing that I want to do is make sure, first of all, how to know how to avoid. I need to be able to identify trends and also how to avoid, let's call them no trends, okay, or sideways markets. That's crucial. So I must be able to understand what constitutes a nice market conditions that are likely to yield profitable trades, highly probable that the market's going to go in my direction. And this is simply something I just don't see outside of Trade with Precision. It just isn't emphasized enough. The next step, and this will come together by the end of the webinar, is then be able to identify, and this is part of what we're talking about, entry opportunities in those trends. Opportunities in those trends. So where do we get into a trend? Where do we put our stop loss? Where do we get out? Yeah, you know, so the comment, this is a good comment. Let's cover that as well. You know, there are some people who like to trade ranging markets, sideways markets, because they'll sell at the top of the range, they'll sell up here and buy at the bottom. But it is very choppy and incredibly stressful as well, because you're intuitively buying when the market starts heading down. There are issues with it. If we focus simply on trending markets, usually those conditions usually are the calmest and where the probabilities of success are very high. So it's once we adopt that, it gets a lot easier, because otherwise what happens is we're then looking at every single chart trying to determine if we can squeeze a trade out of it. Whereas if we just say, look, I'm only going to stick with trending markets, then it's much easier to eliminate markets that aren't trending. Okay. The time frame will come in at some point. So again, I'm going to remove this chart. I'm just going to reduce the clutter on a couple of these things. I can always redraw them if I want to. Okay, there's a few of these. I just simply don't use them that much anymore, so let's just get rid of them. And we got that, we got that. Yeesh, I got so many of these things. Okay, we've got this one. Okay, we've got a couple here we can have a look at. So many of them. Okay, so excuse me, I'm fighting off quite a bad cold, but I'm excuse me, on the tail end of it now, I thought. Wow. Right, there we go. So I've got a range of different markets I can get to. I can access those by going through to the list of symbols. And access any of the items that I wish to look to take advantage of. So what I have done is only loaded up the ones that I am most interested in, but there are a few here that are not highlighted. And really, I've just highlighted my favorites here. So just so that you're aware of that, I've got indices and then commodities and then, of course, currencies. And then what I look to do, so I was talking about identifying entry opportunities into a trend. So if we take this chart here, let's have a look at gold. Gold has been beautiful for a long time. This is a monthly time frame. And this particular behavior, price has been struggling to break above 13, let's call it 1350 around here. 1350 since 2013. All right, it's been really struggling to get back over that particular level. And actually then what it has started to do, starting at 2015, November 2015, started to produce higher lows. All right, struggling to get through this level, but significantly the higher lows indicate that the bulls are starting. This is a particular breakout pattern. And my expectation was, I drew the line in that roughly from this point to here, somewhere, that I was anticipating gold breaking out. It happened to have broken out at this point, so it's broken out this year, looking really good, and has gone immediately up to the key level. So we've identified these key levels, and what it's due to do, what it should be doing in terms of normal general behavior, it should potentially come back down to test this level. So in other words, it found resistance. It's looking to come back and test it again. That's pretty normal. Alternatively, if it is inherently bullish, I would look for it to come back maybe a little bit closer, but this would be great. So what you'll see if I go to the other chart that was also up here, for example, I've actually highlighted those areas. I've highlighted them. What I wanted to show you, this is a weekly time frame, is that you can see that if I go back to the other one, just because it's there, or I go back to the monthly, you can see we have an uptrend, higher lows and higher highs. So we have these technical definitions of what constitutes an uptrend versus a downtrend versus a sideways market. An uptrend is made up at least at a bare minimum of 2 higher lows and 2 higher highs. The turning points at the top are our swing highs. Turning points at the bottom are swing lows. It's got 2 higher lows and almost 2 higher highs at this point, if we consider this maybe a swing high in the making. So it's a nice uptrend. Looks pretty good. In fact, if we start measuring from this point, we can tell price is generally heading higher. That all looks very good. If I go to the weekly, there is definitely an uptrend in place here. We've got higher lows heading up here, and we've got an uptrend in place as well. And now this is where it gets really interesting. So every trend will have an extension in the direction, it's called an extension in the direction of the trend, and a retracement against the trend. This is very normal. This is the market breathing out, breathing in, as market participants get in and out of the market. Okay, so there's no paranoia here. We're not worried about the market being manipulated and controlled. Forget about it. We can trade, and this is the beauty of technical trading, is our goal is always to trade with the trend. So it doesn't matter if it's, and not that I believe in this, but if it's being manipulated, because we're going to basically be piggybacking on the big money. And right now, the big money is trending upwards. I don't need to know why it's trending. I just need to know that it's trending and be able to get in and get out. So I don't need to overthink it. It's beautiful. The analogy I always like to use with trading in this way is surfing. If I wanted to learn how to surf in the ocean, I would go to a particular spot, obviously where surfers are a popular spot for surfers. I need to be able to swim. I obviously need to be able to train as to how to get on the board and catch waves and so on. Those are certain safety and basic skills that I need to have in place. Certain conditions need to be in place. So if I arrive there and the water is so calm that there are no waves, I can't do anything. All right. If it's so stormy and so choppy that, again, there's no real organized set of waves, it's not going to work for me. But between those two extremes, there will be a range of conditions where I will be able to take advantage of surfing the waves. And the key thing will be waiting for a set of waves. I need to be able to identify those waves coming towards me. Then, most importantly, I need to be able to time it so that I can identify a wave I'm going to get on it, and obviously then I ride it. So I ride it as far as it will go, or I determine how many waves I want to catch. How much time do I have? How much energy do I have? If I do it for too long, I'm going to get exhausted and eventually I'm going to hurt myself, and so on and so forth. But there's going to be waves there most days. So the logic here is that at no point while I was doing that did I need to understand the physics behind how waves are formed. I don't need to do that. I don't need to understand the relationship. It can be as simple as arriving at the beach. What are the conditions like? Are they surfable or not? All right, it's the same looking at a chart. Is it tradable or not? There is no requirement for a deeper understanding other than the skill of identifying those waves and also being able to get on them, so to speak. But also importantly, a wave doesn't go on forever. I've got to get off it and then determine if I want to get back on it or not. So trading trends is very much about that, identifying those entry opportunities. Now I've identified these two areas as per the chart that I showed you. I'm looking for an area here where price will either pull back to this area or pull back to this level. And then my expectation is, because it's been bottled up, and this comes from experience as well, for almost 6 years, or 6 years, call it, from 2013 till now, my expectation is that the monthly, at any rate, certainly going and looking at it on a monthly basis, it can do a really nice pullback to here and continue on upwards. So we're going to get to why Fibonacci is relevant here. And we're doing well for time, so that's all good. So, good question here. Let's have a look at this. Is it true that the faster price goes up, the more likely a sideways market is afterwards? I'm thinking about that. I don't, not at this point, have an opinion on that. I'm not convinced yet. The market can, and let's go and have a look at this in a couple of different ways. Let's go back down to the weekly here. So you'll notice, in answer to that question, that price goes a certain distance away from the moving averages before coming back, certain distance before coming back. In this particular case, we can see the price has gone a very long way away from the moving averages. So we would generally call that sort of an extreme overextension, or just overextended. Okay, price is well overextended. It needs to come back to the average of price. And so relative to previous moves over here, I would say this is relatively extreme. To me, this market is actually, because of these price levels, in fact, is very likely to come back down towards these areas rather than go sideways. However, it is possible that the market, and actually the best example that would be looking at, say, something like the indices. Okay, so we go to the indices, look at those on a monthly basis. You can see here that the indices will often, instead of doing a very deep correction, because we're looking at it on a monthly basis here, they can often go sideways. So now the logic behind that actually makes sense. There's a lot of buyers in the market. All right, so the market itself, although it's exhausted and it can't seem to go on for now, the market is not bearish enough to let it come back down. And actually, as soon as it comes down, there's buyers stepping in at these areas. So I would say that maybe with currencies, we've got one currency pushing and pulling against each other. There's always two parties there, tug of war. The market is much more likely, I think, to do a retracement in a very healthy trend. The market, if it's incredibly bullish and very keen to continue, as an alternative to doing a correction, because it needs to do that. It's natural for the market to breathe out, breathe in, breathe out, breathe in. In this case, we can see that's normal. But also what we could have found, hypothetically, if we look at this market here, so I'm going to go down. This is the height of the 2007-2009 financial crisis, okay, over here. And the market at this point went through a consolidation. It didn't come back down to test that level. So in other words, it was so bullish and so strong that it didn't have to come back to correct. It basically consolidated before continuing, and that can happen. So it's very difficult to predict necessarily which one it's going to do, but it's understandable. We can determine if it's going sideways, and these markets here tell me the market's relatively bullish. Okay, but it is not impossible the market could correct. And I want to do an analysis of these markets as promised in the agenda, but I also want to do it as part of the general discussion. So we'll come back to that, because I think that looking at indices and currencies and commodities, all right, they have subtle differences in the underlying mechanics. Okay, so currencies, it's very important to remember that it's two currencies pushing and pulling against each other. That's very important, and we need to understand and respect the fact that there are two parties there. When we look at an index, we need to understand that it has subtle differences. It will generally, over time, decade after decade, will climb, because we have growing markets, we have fresh markets, we have more people on the planet, investors growing, people with more money wanting to put in. These markets are a great way to invest, and they will more often than not will trend upwards. Okay, they trend a lot more. There's a lot of people that sort of say that all markets only trend a small amount of the time. That's actually not true. The indices and equity markets can trend, it's a generalization, but 60 to 80% of the time, depending on what that individual market is. Currencies, because there's two different markets, that can range a lot. That can push and pull and maybe not trend as much. But to me, really good stocks and indices will trend a lot more of their lives than go sideways. All right, and that's really just as a simple result of growth, if there's just general growth. So let's come back to that. Let me talk about gold for a second here. So with gold, I am looking to identify a trend. So I can see visually on the daily, there on the weekly at any rate, there's a nice trend. Now, what we do a trade with precision is we throw in a couple of moving averages, right? So we could throw in simple moving averages, and this is pretty cool because I can have favorites here. So what I could do, for example, is go through to the indicators over here, and what I'm going to do is just highlight a couple of things to demonstrate this more sort of a custom moving averages, for example, and I'm going to make that as a favorite. And that just allows me to quick access it. I can then drag and drop that onto the chart, and I can input a couple of different things here. So I could make this a 50 moving average, make it simple or exponential, doesn't matter too much, make it red, and boom, that's my moving average in the chart. Let's go in and throw another one in, and I'm going to make this one a 20 and a 10. So I'm just going to do 3 moving averages here, and I can make them, as I said, I've got a couple of different options here. Simple is fine. I'm happy to do that, and then we'll do one more for me, which will be the 10 moving average. And the way we do it at Trade with Precision is effectively the standard, healthy, simple trends will have, just go through, I want kind of a dark gray, I don't want it to become too strong. There we go. Simple, healthy trends will have a really good interaction with these moving averages. All right. Now, moving averages are useful if, and trading is a lot about using tools correctly. It's about doing the basic things properly. It's not about a more complex strategy. It's not about complexity. It's actually about simplicity. So what we do is, that's why I said to you, we look at price action first, we look at horizontal levels. Then my problem now, or my the next task for me to do, is to identify entry opportunities into the trend. Okay. So now the best way for me to do that is really good trending opportunities, as I said, respond well to this area in and around the 10 and 20 moving averages. So basically, when I get to Fibonacci, I'm going to tie everything back into this. But it starts, because where I want to get to is really how to turn Fibonacci signals into potential trading opportunities. I want to get there. And I need to understand about horizontal levels. I need to understand about market conditions. I need to understand where are the trading opportunities going to be for me. The next thing as well is that traders will have a watch list of markets that they're watching for entry opportunities. So I'm looking at gold. Gold is on my watch list. It has been for a couple of weeks. It will be on my watch list until price gets to these areas. And that might be 2 weeks from now, it might be a week from now, it could be 3 weeks from now. And obviously in between now and then, I'm going to be trading other markets that are on my watch list. Okay, so it isn't always about having to wait that long to take a trade. It just means that it's on my watch list till price gets to a particular area and I can take it from there. So these moving averages help highlight an area where an entry opportunity can occur. So it's quite nice because I can actually see that this particular area here, which overlaps with this horizontal level, is starting to kind of fall into place. That's really what I'm looking for, is to see price achieve one of those areas. And that's a really good trending opportunity. The next thing that I should highlight here is that if the weekly is retracing, that usually means that the daily is heading into a downtrend. Okay, so it usually means that for that temporary period, the daily will go into a short-term downtrend. And this is where beginner traders can often get tripped up. They're looking at the 1 hour, which is going down, and then they sell on the 5 minutes or something, and then it turns out that actually the 4 hourly was just doing a temporary retracement, and the 4 hourly, the daily, and the weekly are all going up. So as soon as they get in, the market turns around and changes direction, and that's usually because of that factor. So the daily here is not in a downtrend just yet, but the 4 hourly is in a downtrend, and so there are some potential, and this is where entering a trade is slightly higher risk. The probabilities of gold ultimately coming down to these two levels is very high. So I can arguably trade it down to these levels, but I must at least concede to myself that this is higher risk. I'm trading against the weekly trend, which is just doing a retracement. The daily is not yet in a confirmed downtrend. There's no lower high, lower low. It's just pulling back. The 4 hourly is in a downtrend. So what does this mean? Well, there's key levels here you can see there's a support level here I need to be aware of. Excuse me. It just means that I have to accept that there is a slightly higher risk on my trades if I'm going to be impatient and not wait for price to get down here, and I want to trade it down on the way down. So it's just an interesting approach is that can happen if we get impatient. It's not really the best trend. It's not bad. I can see the 50, 20, and 10 are starting to move down. Got out to the 1 hour, and it's okay. It's not a great trend. It's definitely got some levels of support and resistance, temporary ones, intraday ones. I need to have the key daily ones identified. So I don't want to suffer from analysis paralysis. So I want to look at the monthly, weekly, and daily and get a sense of that. So let's talk about Fibonacci, because I suppose you're wondering why we haven't got to it yet. Not a big reason. Fibonacci, for those of you who are not familiar with it at all, Leonardo Fibonacci, not to be confused with Leonardo da Vinci, but equally as amazing, lived almost 1,000 years ago. He was a mathematician, and one day he was challenged by someone to try to come up with a formula to calculate how quickly 2 rabbits could reproduce. And while he was working on that, he discovered, interestingly enough, patterns in nature. Okay, and he came up with a couple of mathematical formulas, but it had a lot to do with proportions. Okay, so there are certain proportions that are built in naturally into nature, into us, into plants, trees, insects, everything. And these are ratios. And they're just there, they're inherent, they're just in the universe, they're everywhere there. And there's a very, if you get the time, it's only 2.5 minutes long. It's not very long. There's a YouTube video. If you do a YouTube search for Fibonacci in nature, blow your mind. And it's just extensive and it's everywhere. Okay, so in the shape of dragonflies, the eyes, the wings, and the body proportions. And so we have it. At some point, somebody decided to see if Fibonacci ratios existed in the financial markets. And actually, they kind of would. The financial markets, as much as we would like to think they are man-made, they are also crowd behavior, like a flock of birds or a shoal of fish. Excuse me. So they are just, and they therefore carry our, I guess, our, everything, our evolution within them. I'm not going to make it into some kind of voodoo stuff, not really at all. Just that we can't help but imprint our and this comes from the entire planet. This isn't, and from the universe. It isn't. It's just in nature. It's not just particular humans. To humans, we imprint proportional behaviors to everything we do. Now, there are key levels, absolutely. So if you go look here from a trading perspective, the most commonly used Fibonacci levels are 382, 38.2%, 50%, 618, and sometimes 236 and 764. There's also 786. It gets a little bit complicated. The 50% is, strictly speaking, not a Fibonacci number. It is just a halfway point. So if you've ever heard that expression, 2 steps forward, 1 step back, it's the same kind of logic there. 50% is just, to us, a midway point. We're always aware of where the midway point is, unconsciously or consciously, and the rest of these are very much present. Now, what he also came up with was what was called the golden rule. Fascinating to learn about it, but basically there are just all these amazing patterns that overlap and work out, and these ratios. So the title of the webinar was as easy as 1, 1, 2, 3. And actually, that's a joke that Fibonacci fans enjoy, whether you're a mathematician or whether you're a trader. 1, 1, 2, 3, the logic being that 1 plus 1 equals 2. 1 plus 2 equals 3. So that's where that comes from. So 1 plus 1 equals 2, 1 plus 2 equals 3. Then the next number in the sequence would be 5, which is 3 plus 2 equals 5. The next number is 8, the next number is 13, and it keeps going. So basically, we're always adding the previous numbers together. And but there's a proportionate difference between them. So if you take, let's have a look at this. Let's just do this for fun because it'll only take 30 seconds. If I take the number, I just want to see what happens if I take 13 and divide it by 8, I get 1.625. If I take 8 and divide it by 5, I get 1.6. So there's a bit of a proportion that's coming into this. If we take 5 divided by 3, 1.66. So there's a ratio, right? And so that's often called the golden rule. The golden number, and anyway, and so that's what it works out. But there's also these other different numbers that are produced from that. If we go to the Fibonacci tool, which is listed up here, draw Fibonacci retracement, and actually while we're at that, you can right click and you can customize these shelves. It's pretty cool. If you go onto it, you can remove or add certain items. So I don't use any of these. So I've removed them to declutter my chart, and I've thrown in Fibonacci. Okay, so that's just how I managed to get it up there. Then if I click on it, I can use that. What I'm going to do is switch this to a weekly time frame and just draw this in. So it's important. So the reason I spoke about trends, the reason I spoke about how I'm looking to get in, is I want you to understand why on earth I would be looking to buy in this market, and also how I'm going to build up a case to take a trade. So if I use Fibonacci here, the skill is I need to help identify an area where I'd be looking to get into a trend. And one of the ways in which I could do that is obviously measure Fibonacci. So it's a little difficult to see here, so I'm going to change the color to something you can see. And so you can see the numbers as well. You can see 23.6, 38.2, 50%, 61.8. I've actually edited this, and I'm going to show you how to do that as well in a moment. The key thing is that if you imagine that price is going to retrace from this major swing low here, there's a major swing low, there's a big swing low, here's a big swing high, at least on a monthly basis, you can sort of see them. There's the big swing low, swing high, swing low. This is potentially forming that swing high. If we go to the weekly, there's a couple of smaller ones in there, swing low, swing high, swing low, and it says potential ones, but I'm going to be focusing on, and this is a little bit of a tip for myself at any rate, is it should be obvious. I don't want to stress and strain about areas like this where it's so choppy and messy, I can't identify if it's a swing low or a swing high. In this case, because that area is a little bit choppy, I'm not going to stress about it, but here is an obvious swing low, and here is definitely a swing high that I want to measure. So what the logic is, if I just remove this temporarily, is I want to measure, I want to see if price heads forward in its extension and then does a retracement, I want to see what that Fibonacci retracement is. So that's what we're doing. I'm basically measuring if it comes back halfway. So keep in mind, here's my swing low, and this is the swing high. If price comes back halfway between this point and this point, that would be a 50% retracement. So that makes sense. That would be a 50% retracement. And if it carries on back down to here, that would be 100% retracement. In other words, it's retraced all the way back down. So the Fibonacci retracement should always be measured from the most recent swing low in an uptrend to the current swing high. So I can see now price is on its way back. It's coming back to this area somewhere. I need to see if there are any important Fibonacci levels that overlap near these key numbers. So what I'm trying to do here, ladies and gentlemen, is to throw Fibonacci on, which is a recognized either cause and effect or self-reinforcing or whatever, but it's a recognized way of measuring it. I'm not just going to make trades based on Fibonacci. That's not the way to go. I'm wanting to build up a case that supports the idea that price is much more likely to go in my favor than go against me. So by looking at a monthly uptrend, give me 1 second. So I want to build up a case that helps me get an entry into a trend. This has got a monthly uptrend, it's got a weekly uptrend, and it helps me identify the areas where at least the weekly is likely to turn around. So I might get in on the daily. I'm not necessarily going to get in on the weekly, but I need to see that the weekly is likely to come back to these key levels. Now I find it interesting because if these levels are also close to Fibonacci levels, that reinforces my case. That helps reinforce areas where I could look for price to find additional orders, because you've got traders around the world who are using Fibonacci levels for their orders. You've got traders using price levels as well. You've got traders maybe using pivot levels, weekly pivot levels, monthly pivot levels. You've got traders using round numbers. And so basically, the more things that I can find that overlap, the stronger the likelihood is that that is where price is going to find a lot of orders and get filled. And so you'll notice I'm stepping away from the idea of voodoo, and hocus pocus. This is practical trading. I'm just reading your questions. The webinar is being recorded. I will be uploading the recording. So my understanding is, don't hold me to this, but my understanding is you will get a copy of the recording in a follow-up email. So the next question is, in certain market conditions, it's difficult to discern whether a movement is part of a trend or rather a correction, right? Okay, how could we know? Okay, so good question. This is a trend. Okay, this is a trend. It's smooth, it's got high lows, highs, it's nice and orderly. This retracement is what we have to do is, it's kind of innocent until proven guilty. We have to treat the trend as a trend until it is not a trend anymore. But there's a little bit of experience that comes into this as well. This is gold. The bullish breakout pattern that's been going on since 2013 tells me that gold is finally free to resume its much longer term uptrend. So you can't really see this, but if I zoom out here, this move here over the years and this pullback, we can't go higher than a month. But if I could go and have a look at this on a quarterly or yearly time frame, this would basically be an extension, a retracement, and it's starting its next extension. So that's a bit of experience coming in. That just comes from knowing, from having done this for a while, that this is a trend, and basically this is still a trend, and I'm looking to get in here. Remember, this is what's cool about this, is that I'm going to wait for price to produce an entry opportunity in an area where I'm anticipating that. So in other words, if the market doesn't produce that entry opportunity, I'm not going to get in. So there's no skin off my nose. I'm trading other stuff, but in the meantime, gold's on my watch list. Price comes back and I get an entry opportunity. Two things will happen at that point. It'll take off exactly as planned and continue up, or maybe it'll trigger me in and stop me out, and then I'm out. And that losing trade in that case constitutes part of my allowed losing trades. Out of every 10 trades I take, I'll have more winning trades than losing trades. Definitely. That's just how it goes if I am selecting my trades based on evidence in a trend. I'll be right more often than I'm wrong. But that out of every 10 trades I take, the number will vary. It might be no, I might have no losing trades. I might have maybe 4 or 5. But generally, and from experience, it would be very unusual for me to have 5 losing trades out of 10. It's not impossible, but it's not very common. And I still would make more money on the winning trades than I would lose on the losing trades. And that's what trading is about. Trading is about identifying really good conditions, finding entry opportunities, managing my trades professionally, taking profit, absolutely taking profit. As I go, I'm taking profit out because I'm going to do this over and over again. It's like surfing. Look for the waves, catch the wave, ride the wave, get off, get back on, catch the next wave. And because this is what I've been doing, this is what I do for a living, it's how I earn my income. This is just, I know that's how the markets work. But it starts, that success starts from selecting a market that is trending. If I go to markets that have no clear direction, the market's all over the place. When I pick markets that are trending, there's a thing about trends. They attract professional, experienced traders. They're very attractive to them. As you get older, you get lazier because you've got the skills. You're not going to take 20 trades if you only have to take 4. You become much more selective about what you can trade, and you trade only those. So trending markets attract the best traders, and they're much more organized and professional in their behavior. And so in a way, it kind of a trend maintains its order for longer because the participants are very orderly. So if we go and compare this to silver, so here's silver at the moment. I've also highlighted that. Look at that. Prices come back. There is my really nice little bullish candle. That was one area I was looking for it to come back to. If you go and have a look at it on a weekly basis, you can see that silver is not as pretty as gold. So it's not really my first prize, but you can also see if we highlight these key levels, here we can see, for example, let me go and have a look at this as well. I want to go and highlight this. Sometimes I might switch over to the curve just to see where prices turned around. And go back to these. If I now go back to that daily, I could see, or potentially down to these levels. What was it on here? It was daily. There we go. So the daily has come back and found a historical level. Looks really nice. I'm going to get rid of this little area tool here. Let's just get rid of that here. Which one is that now? Okay, so Is it on this chart? I'm just going to highlight that and that one. Let's get rid of these. Delete, 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 delete. Okay, there we go. So to me, it would be very interesting if this also happened to coincide with a Fibonacci level. And this is where it gets really cool. On the Fibonacci ratios, I'm going to measure from this one and from this one and from here just to see what it looks like. If I measure from this swing low up to there, that's really interesting. It lands on a 382, which overlaps very closely with that horizontal level. So these, if I just double click on that, I can edit the Fibonacci properties. I can see these numbers. I can add in levels that I want. For example, if I don't want the 23.6, I can actually delete that. So that will remove it from the next one I draw. I've got 50 fib, 618. I can do a 76.4. So let's say, for example, I go in. And so this one will be, let's just do that at 0.764. For example, let's just go through and have a look at that and then type that in as 76.4. Okay, 76.4. So I'll have a variety. I can create those ones and then I can say, okay, and it'll edit that in. And now any other ones I draw in future will be the same. They'll all have the same information. Okay, they all have, that's how they go. Okay, so there we go. And I can add them or remove them. So that overlaps really nicely on that from this swing low. So if I go ahead and measure it from, it should always be from the most recent obvious swing low. So just out of curiosity, this is a bit of a mishmash. This was clearly a news announcement. You don't get this behavior normally. That's a news announcement like non-farm payroll or some kind of interest rate FOMC. You can see here in this particular, we also like to treat it as a region. I don't really count this as a proper swing low. I prefer this one or this one because it should be obvious. But I'm doing this as part of the exercise. And what I also wanted to mention is that the 50% to 618 is a really good place for price to retrace. It's great. It can come back down to the 382. And so the logic we approach is you saw how I identify these key levels. And what I'm doing now is those are to me the minimum areas where price could retrace to. So in this case, price has pulled back to this level. It also happens to be when I measure it from here, it happens to land on a Fibonacci level as well as a horizontal level. And in this case, I also wanted to highlight that the 50 to 61 as an area is similar to the 10 and 20 moving averages as an area. It is an area where price often pulls back. It doesn't have to, but it often pulls back, and good entry opportunities in a healthy trend can often occur from this. A very, very strong trend that doesn't want to quit will do a shallower retracement, but it can't do it forever. Eventually, it's going to do a deeper retracement. But a shallower retracement, usually the 382 in a very strong trend, but otherwise 50 to 618 is very, very powerful. On rare occasions, coming down now to the 76 level, but deeper retracements are not always a great sign. They can often show the market is testing way more lower in an uptrend or more extreme than it should be. Next thing I want to do is just measure from this swing low to see if that overlaps, and it does. So we've got a really nice bounce off a 50 fib level, which is close to this horizontal level, so it's really nice. And if I just show you again from that one there, I get a 382. So that's really nice. We call this a cluster when it overlaps very, very closely to these key levels. And so what this does to me is we've got a horizontal level in a beautiful uptrend. Gold is also trending. We've got a very nice bullish candle in the buy zone, which is in the 10 and 20 moving averages. I've got a horizontal level. I've got from one of the longer measurements, I've got a 302. When I bring it to the next most obvious retracement, I get effectively a 50 fib level there as well. And so what that does is I now have two Fibonacci levels depending on which measurement I use, and that's perfectly acceptable. This would be the first one usually, but if I measure it from another higher time frame or from another swing low, and I get another Fibonacci level, what that does is that actually reinforces the idea. That's called the Fibonacci Cluster. It means that different traders who might be measuring from different swing lows in this case or from a different time frame will get the same results. Okay. Measuring from this one down here is just too extreme at the moment. But again, and that's a really great way of measuring it in this example. Okay, so in that uptrend. And it's a very, it's very powerful. We don't, I used to, I mean, I like it very much, but pivots, Horizontal levels, very powerful. Fibonacci is very powerful because other traders use them, and therefore it's a crowd behavior. Okay, so they're quite powerful in that extent, and price can often do it. And what's interesting is when price does the same kind of behavior. So you might find that in a short-term trend, the market is retracing 50%, then up, then back 50%, then up, then 50%. It is capable of retracing to those key levels. So let's measure it again from here. If I go measure from here and I measure from this swing low up to there, I don't really find any very tight clusters, but a pullback into this area is the 50 fib or the 618 in this area reinforces it. 382's down here. So what I would do, I can leave the Fibonacci measurement here and look to see if I get any really nice price action. Support levels there, out of curiosity, I want to just bring it down to this big one, and that doesn't really line up with any of these either. It's not the end of the world if it doesn't, but it does help me highlight areas where price might be looking to come back to. So again, I can measure it from here, and these are just different time frames. So again, I'm looking for price levels because it is ultimately, we forget about this, but it's about price levels. All right, I don't have to understand why gold has broken out of this. When we were looking at this months ago, even a year ago, we knew that it was going to be something that would trigger it. It was going to be war, it was going to be something, or it could just be demand. It could just be electronics demand, it could be anything. We don't need to do that. That's not the secret to it. As technical traders, we need to just be able to identify those conditions. Okay, so that looks pretty good. I still am of the opinion gold has the potential to head down a lot lower. So having a look very quickly at some of the other markets, we've just got some of these ones here. So you'll see during this period, for example, the market did a largely sideways movement. But if we're going to be looking for those trading opportunities on the daily time frames, and so I'm just going to remove some of these and just I want to zoom in and have a look at these and zoom in a little bit more and go and have a look. These retracement opportunities can obviously present themselves on a regular basis. So really the key thing to take away from this today is using Fibonacci within a trend. Okay, so if I go ahead and measure from this one, from this previous swing low up to here, if price was busy retracing, you could see it pulling back, and now I might as well change the color again. So now it's going to go back to the blue color or magenta. Let's just go blue. Let's go blue. There we go. It comes back into that 382, 50 area, that price level there as well. There might be a round number there as well. 2,700 could work really, really well. And we might find, for example, if we go ahead and just measure this again, so if I go up to here, here's the next big swing high, and I adjust it, you can see it's actually pulled, in this case, back to a 382 level. If I go ahead and adjust this one and move it up to the most recent swing low, you can see it's putting back into the 618, into this area here, 618, nice little bullish candle. So really our goal is to use Fibonacci to give us a sense of proportion. Has the market done at least a certain amount of proportion? So usually I will stay away from markets that only do a 20-something percent retracement. I'm looking for the market to ideally pull back to the 382 to the 618 in this area, which we could kind of call the buy zone in an uptrend, and the same in a downtrend. So if we have a downtrend, we can go and have a look at that. So we use these more on a trend. So the question is that it can identify a sideways market. For the most part, horizontal levels will probably be more efficient in identifying a sideways market. And Fibonacci works incredibly well in a trending market because of those natural retracements. So what I want to do here is just quickly have a look at Euro Yen, because that had a very nice strong trend to the downside. Let's get rid of the grid and just bump it up to the daily, for example, and have a look at a currency from that perspective. Okay, so for example, here are some key levels. We've obviously got a key level there, support resistance at that point, and we've got a couple more at that point as well. We've got a couple more up above this. If I just go through and highlight a few of these areas, I might decide that that's an important area. Switch that back over to the candlesticks, for example. And so, yeah, I might be looking then for an entry opportunity if this is a weekly retracement. Okay, I might now be, same thing again, looking for a weekly retracement for price to come up to that. And here, and I'm going to have to change the color yet again, measure from that most recent swing high. I can see price now approaching at least a 382 or a 50 fib. So the key thing here is that I'm not only identifying that, I'm not saying the market has to turn. What I'm doing is I'm highlighting areas where a bearish signal in a downtrend or a bearish candle combined with a support resistance level, combined with a Fibonacci level, maybe also within the moving average of the 10 and 20 moving averages, has now given me 4 or 5 different reasons why the market is turning, could be turning here to resume its downtrend. So this is a downtrend. Okay, so at this point, I will treat this as a downtrend until it is no longer a downtrend. Therefore, if I get a bearish candle here, I will treat that. And this is obviously where confidence comes from. We know that every trade we take is not guaranteed to be a winning trade, but if we continually only look for trending conditions with bearish signals or an uptrend with bullish signals, and we build up that case with price in the moving averages against support resistance level, against a Fibonacci level, we find that other traders will follow through on that as well, because that's where those buy and sell orders are. And it really becomes self-reinforcing, which is all we really need ultimately over and over again. So, ladies and gentlemen, that actually brings us to the end of the webinar. Just going to quickly tell you something about this. I need another 1 minute of your time, and then I will wrap up this webinar. So ATFX are regulated by the FCA. You've got their license number there. There's a very efficient, secure, and easy to use payment portal. They're committed to providing competitive pricing for their clients, and global investors obviously using that most widely used trading platform, MT4, which has got a wide range of tools that can even be added to it as well. And there are additional tools that come with the ATFX platform. And of course, bespoke customer service and trade support for all client trading needs. I've been in their offices when they answer the phones. So everybody accesses the phones. I mean, they're quite committed to their clients' trading success. These are the contact details. Should you have any questions at all, please feel free to contact them. They'll be more than happy to answer your questions. And thank you so much. Again, thank you for the interaction. I love it. I look forward to seeing you in future webinars, if it's not myself or one of my colleagues from Trade with Precision. But yeah, absolutely. And please bring the questions. I'm more than happy to cover particular markets you want me to have a look at. And we do cover different things in the different webinars. But yeah, thank you, ladies and gentlemen. And I want to wish you a fantastic evening, depending on what your time zone is, and enjoy the rest of your week. So thank you very much. I'm going to end the webinar. It's going to hoof us all out. Thank you, Stephen. Take care, Vincenzo. Thank you, ladies and gentlemen. Goodbye.